is up? What's up, traders? Hope you're all doing well. It is. Let me see. How does this? Can I do this? Oh wow. Okay. Anyways, it's what is it? It's April 17th right now, Wednesday, middle of the week. After Jay Powell comes on the wire yesterday, we got some more stuff to talk about, right? Based on what was said yesterday, many Fed speakers into the afternoon, we saw just whip, 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 whip. So that was as expected, realistically, into this afternoon. So we pretty much, right, can start solidifying the much awaited Fed pivot is starting to materialize, but it's not necessarily, oh, excuse me, gotta get that out of the way. It's not necessarily what investors and traders had been expecting. The change was supposed to signal that the central bank finally reversed course on its contradictory monetary policy path, which has been in place since March 2022. It would come after Powell and company continued to telegraph that rates were soon in the cards, or rate cuts were soon in the cards, I should say. But policymakers are now formally taking a step back on those forecasts following 3 consecutive months of stronger than expected inflation. So transitory or not, that was one of the mistakes that they made earlier on, and look at what happened. Now, the market went to all-time highs. But as we're looking at this, remember, I've talked about this like almost every day, where the expectations leading into this year was 7 rate cuts. Right now, we're kind of on the verge of like 2 to 3, from what I've seen. The recent data have clearly not given us greater confidence, and instead indicated that it's likely to take longer than expected to achieve that confidence. That's what Jay Powell said at the Wilson Center in Washington, D.C. Last year, rebounding supply supported U.S. growth in spending and also employment alongside a considerable decline in inflation. The more recent data shows solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning our 2% inflation goal. Many had predicted that the last mile of inflation fight would be the hardest, and the latest comments didn't necessarily rock equities too hard, but the central bank has made it clear that incoming data would determine its path forward. Suffice it to say that things will be higher for longer, but for that time being, the next rate move is still forecast to be cut. Things could get rocky if the stance ends up shifting to a hike, right? Which could happen if price pressures resurface and put a so-called soft landing in doubt. With continued hotter than expected inflation data, something like that could come about. The benchmark 10-year yield in the U.S. Treasury notes just closed at its highest level since November, settling at 4.657%. Remember that the yield came into this week at 4.25 about, and started this year at 3.88, meaning that the 10-year yield is now nearly up a full point in 2024. So generally looking at this, that puts some decent downside pressure in bonds and these equities. I didn't necessarily think we'd get that high. I thought we'd top out somewhere at that 4.3 level, 4.35, but here we are with this continued upside momentum in the yields. So we'll see how that kind of balances out, but I think that bonds, as they get cheaper and cheaper this year, there's going to be some kind of bottoming out where yields start falling and bonds look very attractive, as things have been pulling down on equities and bonds alike, right? If we take a look at TLT here, TLT has been beat up very aggressively on this last drop. As you can see, the US 10-year yield, you can see them here on TradingView, has been on the rise as well, right? I was looking at this blue box as kind of the top band of the yields this year, but you can see that we're much above that right now. But I'm looking at this as a potential decline somewhere in the following months when the Fed starts bolstering that they're cutting rates significantly throughout the year, if that would happen. Now, we've seen that earnings have started, right? Next week we have a better case for big tech companies, and we'll see how innovative they really are. But all major banks reported earnings and topped expectations as improved sentiment drove rebound in investment banking and a strong trading performance. It also showed that the corporate earnings story is still intact, while the banking system seems to be in very good shape, noted some analysts and investors across the board. However, like many post-earnings movements, the trading reaction differed among the many players, right? Morgan Stanley and Goldman Sachs, right? You can see here they've gained a bit, even though yesterday they pulled down. Goldman Sachs is pulling down right now. as investors cheered their Q1 results, while things went a little more south for the likes of Bank of America, JP Morgan, Citigroup, and Wells Fargo. So next week, I believe we're kicking tech earnings off with Netflix. They're usually the first ones to go. We have them on April 18th, so I lied, that's tomorrow actually. So if they kick this off tomorrow, the first earnings from big tech, I believe Tesla is somewhere around that point as well. They're next week, and then the rest follow suit. So those are going to be the main important ones as we see these markets react heavily to big tech earnings. So as we come into today's session, we also had the International Monetary Fund, IMF, that talked yesterday, I believe. They boosted the 2024 global growth forecast to 3.2% compared to the previous 2.9% outlook estimate earlier this year. And the strong recent performance of the U.S. reflects robust productivity and employment growth, but also strong demand in the economy that remains overheated, according to the agency. Now, the fiscal stance out of a long line of long-term fiscal sustainability is of particular concern. It raises short-term risks to the deflationary process as well as long-term fiscal and financial stability risks for the global economy, something we'll have to give, right? Surprise, surprise, as we teeter on, as we continue with this broader market rally as we've seen over the last year on very high rates, right? At a certain point, we'll see a more significant pullback, but until that comes, right, trying to time it, trying to guess where it is, it's going to be mission impossible as I see it. I think that a lot of people are looking at this as the major pullback, but I think that we're going to start seeing bottoming out before these guys start cutting rates. Now, let's take a look at what's going on here in these equity markets, mainly the S&P 500. As yesterday we traded a big balance, right? The only way that this balance breaks is if we actually start bidding well above that 51.10 as we target that 51.23.24, and above that we clean the auction. I don't want to blindly just be like, oh, this is what I have to trade, right? This is what I have to do. I'm looking for this upside move. I'm going to see if they actually break and hold those areas. Otherwise, right now we're trading a very heavy, top-heavy volume profile before the day starts. So under this 10, under this 8, right, we take control of all those stuck longs that have accumulated and try to pull it back down. I'll be watching that 92 and 80 for rebounds. I still like the idea, right? I'm not necessarily married to it, but I like the idea of us trading 50, 65, 60 before we get that real buy pressure that springs us back up to complete some of that auction. So I'm not inherently bullish today. I'm only bullish above this like 23, 24 on the ES mainly. Otherwise, right, it can get dicey and choppy. Balance is expected to trade. And with that being said, right, reduce the risk size, risk quantity, and just keep diligent, right? Manage risk and everything else will follow suit. So let's open up our live room here with our traders. We'll see how this day shapes up. If you want to trade this live with us, check out TradeProAcademy.com, community.TradeProAcademy.com for our free Discord. And as things stand right now, I'll see if they want to actually hold above this 51.10, and you can see the delta that's shaping up here from the last few days, marking a very strong resistance point as the accumulation of longs are getting trapped into highs and shorts getting trapped into bottoms. That's very indicative of a balanced market, and with that, what we generally see is chop swings from one end to the other, and trying to anticipate a breakout of that move can be very, very cumbersome for your trading accounts. So if you want to anticipate a move to break out, right, you want to be long from well below or short from well above in the direction of that current balanced move. So that's it. Let's get Wednesday over with because it's the middle of the week and I don't really like it for some reason, but let's move into the end of the week and we'll